Warren Buffett officially retired as CEO of Berkshire Hathaway on January 1st, 2026. After 60 years building a $1.1 trillion empire, the Oracle of Omaha handed the keys to Greg Abel at age 95. Here's what just happened. On December 31st, 2025, Buffett's last day as CEO ended. On January 1st, 2026, 4 days ago, Greg Abel became the new CEO. Berkshire stock immediately dropped 1.4%. Investors are nervous, but this wasn't a surprise. Buffett announced his retirement at the May 2025 shareholder meeting, giving 7 months' notice. Yet the stock fell 14.4% from its all-time high of $819,350 in May to a low of $692,600 in August. It recovered to end the year at $754,800, still down significantly from the peak. The message is clear. Wall Street doesn't believe Greg Abel can replace Warren Buffett, and they might be right. Abel is inheriting $381.6 billion in cash, a portfolio with Apple, Coca-Cola, American Express, and 90-plus other businesses ranging from railroads to Dairy Queen. He's taking over a company that returned 10.9% in 2025, trailing the S&P 500's 16.4% gain. But here's what's really concerning. Buffett will remain chairman and continue writing annual letters. He's not fully leaving, which raises the question, can Abel truly lead while Buffett is still watching over his shoulder? And what happens to Berkshire's investment strategy under a CEO who's an energy and utilities guy, not a stock picker? In this video, I'm revealing what really happened on January 1st when the greatest investor of all time stepped down, who Greg Abel is and why investors are skeptical, what's happening to Berkshire's $381.6 billion cash pile, and whether you should buy or sell Berkshire stock in the Abel era. But before we dive into the end of the Buffett era, if you want to understand how leadership changes affect your investments and protect your wealth through market transitions, subscribe to The Investor's Lens. We reveal what Wall Street won't tell you. Hit subscribe now. But there's one fact about Warren Buffett's successor that is by far the most important, and it reveals why investors are so nervous about this transition. It's Greg Abel's background. And he's nothing like Warren Buffett. Let me give you the context. Warren Buffett is one of the greatest stock pickers in history. He made his fortune analyzing companies, finding undervalued businesses, and holding them for decades. He's a capital allocator who turned $10,000 into billions through investing genius. Greg Abel? He's not a stock picker. He's an operator. Abel joined Berkshire in 1999 when Berkshire acquired Mid-American Energy, where he was CEO. He spent the last 26 years running Berkshire Hathaway Energy, the division that owns utilities, pipelines, and renewable energy projects across North America and the UK. He's excellent at what he does. Under Abel's leadership, Berkshire Hathaway Energy grew from a $9 billion acquisition to a $90+ billion business. He knows how to run companies, cut costs, invest in infrastructure, and generate steady cash flow. But here's the critical difference. Abel has never demonstrated public stock-picking ability. He's never published an investment track record. He's never written about his investment philosophy. We don't know if he can analyze financial statements and find the next Apple or Coca-Cola. Buffett built Berkshire by buying undervalued stocks and holding them forever. Apple, Bank of America, Coca-Cola, American Express, these weren't acquisitions. They were public stock purchases that became massive winners. Can Greg Abel do that? Nobody knows. And there's another concern. Abel is 62 years old. That might sound young compared to Buffett at 95, but consider this. Buffett ran Berkshire from age 35 to 95, 60 years. If Abel runs it until age 85, which would be a long tenure, that's only 23 years, less than half of Buffett's run. Berkshire needs decades of consistent leadership to maintain its culture and strategy. The Uncertainty about Abel's long-term tenure is making investors nervous. There's also a personality difference. Buffett is charismatic, quotable, and beloved. His annual shareholder letters are read by millions. His folksy Omaha persona and witty one-liners made him a cultural icon beyond finance. Abel is quiet, reserved, and private. He rarely gives interviews. He doesn't have a public persona. At shareholder meetings, he speaks in careful, measured corporate language. He's competent, but not charismatic. That matters because Berkshire's stock premium, the amount investors will pay above book value, is partly based on the Buffett premium. People trust Warren Buffett. They don't know Greg Abel. And here's the biggest unknown. Berkshire's investment decisions have historically been made by Buffett and his longtime partner Charlie Munger, who passed away in 2023. Now it's Abel's show. Buffett announced he'll remain as chairman and continue writing annual letters. But he's 95. He can't be involved in day-to-day decisions forever. Within 2 to 5 years, Abel will truly be running the company alone. The question everyone's asking, can Greg Abel, an energy executive with no proven public stock-picking record, successfully manage a $1.1 trillion conglomerate built by the greatest investor of all time? Wall Street's answer, based on the stock price reaction, is, we're not sure. But the bigger question isn't about Abel's abilities. It's about what he'll do with Berkshire's massive cash pile. This next issue is perhaps the most critical because it determines whether Berkshire grows or stagnates under new leadership. It's the cash pile, and at $381.6 billion, it's both an opportunity and a massive burden. Here's the situation Abel inherited. Berkshire Hathaway holds $381.6 billion in cash and treasury bills as of Q 2025. That's the largest corporate cash pile in history. Apple has about $150 billion. Microsoft has $130 billion. Berkshire has more cash than both combined. Why is there so much cash? Because Warren Buffett couldn't find anything worth buying. For the past 3 years, Buffett has been a net seller of stocks. He sold $110 billion worth of Apple, $15 billion of Bank of America, and multiple other positions. He raised massive amounts of cash because he thought stocks were overvalued. He was waiting for a crash to deploy that cash at bargain prices. But the crash never came. The market kept going up, and now Greg Abel is stuck with $381.6 billion earning about 5% in treasury bills. Here's why this is a problem. Berkshire's operating businesses, insurance, railroads, utilities, manufacturing, retail, generate about 40 or 50 billion in annual earnings. That money flows into cash every year. So the cash pile keeps growing even without selling stocks. If Abel doesn't deploy that cash, Berkshire becomes a money market fund with a bunch of operating businesses attached. That's not what shareholders signed up for. But deploying $381.6 billion isn't easy. You can't just buy $10 billion here and $20 billion there. At Berkshire's size, they need elephant-sized acquisitions, $50 billion to $100 billion deals. And those are rare. In the past 5 years, there haven't been many quality businesses available for sale at reasonable prices. Private equity firms bid up prices. SPACs overpaid for companies. Everything is expensive. Abel has a few options. Option 1, buy back Berkshire stock. Buffett suspended buybacks in Q2 2025 because he thought Berkshire stock was overvalued. With the stock down 6.7% from its peak, maybe Abel sees value now. A $50 billion buyback would boost per-share value for remaining shareholders. Option 2, make a massive acquisition, buy a $75 $100 billion company. But what's available? Most companies that size are already public, and their stocks are expensive. Private deals are hard to find at this scale. Option 3, return cash to shareholders via dividend. Berkshire has never paid a dividend. Buffett hated dividends because they create taxes for shareholders, but Abel could break tradition and pay a special dividend. Shareholders might love it or hate the departure from Buffett's philosophy. Option 4. Keep building cash. Wait for a market crash and buy stocks at 40–50% discounts like Buffett did in 2008–2009. This is the most Buffett-like approach, but it requires patience and the right market conditions. The problem? Abel is under pressure to prove himself. If he sits on cash for 2 years while the market goes up another 20%, shareholders will revolt. But if he overpays for acquisitions just to deploy cash, that destroys value. This is a no-win situation. Abel inherited the biggest cash deployment challenge in corporate history at the worst possible time, when everything is expensive and he's trying to prove he can replace Warren Buffett. Whatever he does, half of shareholders will think it's wrong, and the stock will trade accordingly. But there's an even bigger structural problem with Berkshire that nobody's talking about. Here's the valuation issue that has plagued Berkshire for years and could get worse under Greg Abel. It's the conglomerate discount, and it means Berkshire's stock is worth less than the sum of its parts. Let me explain what this means. If you add up the value of all of Berkshire's holdings, the stock portfolio, Apple, Coca-Cola, American Express, etc., the operating businesses, GECO, BNSF Railroad, Berkshire Hathaway Energy, etc., and the cash, the total is more than Berkshire's market cap. In other words, Berkshire stock trades at a discount to its intrinsic value. Analysts call this the conglomerate discount. Why does this happen? Because investors don't trust conglomerates. They think the different businesses would be worth more if they were separate companies. A railroad company should trade at railroad multiples. An insurance company should trade at insurance multiples. Bundling them together confuses investors and creates a discount. For decades, the Buffett premium offset the conglomerate discount. Investors paid extra to own stock managed by Warren Buffett. His capital allocation skill and investment track record justified a premium valuation. But now Buffett is gone, and the conglomerate discount could expand under Greg Abel, who doesn't have Buffett's reputation. Here's the math. Berkshire's book value, the accounting value of assets minus liabilities, is approximately $680,000 per Class A share. The stock trades at $754 for $800. That's a 1.11x price-to-book ratio. Sounds reasonable, right? But historically, Berkshire traded at 1.3–1.5x book value during Buffett's peak years. The Buffett premium justified paying 30–50% above book value. At 1.11x book, there's almost no premium. The market is saying a Berkshire without Buffett is worth approximately its accounting book value, nothing more. If the conglomerate discount expands further, which it could under Abel, Berkshire might trade below book value. That would mean you could buy Berkshire stock for less than the sum of its parts. Activist investors would start circling. They'd push to break up Berkshire, spin off divisions, and unlock value. This is exactly what happens to conglomerates without strong leadership. And there's another issue. Berkshire stock has underperformed the S&P 500 in recent years. In 2024, Berkshire gained 25.5%, while the S&P 500 gained 24%, roughly even. In 2025, Berkshire gained 10.9%, while the S&P 500 gained 16.4%. Berkshire lagged significantly. For buy-and-hold Buffett disciples, this is painful. The whole point of owning Berkshire was to beat the market over time. If Berkshire just tracks the market, or worse, lags it, why not just own an S&P 500 index fund with lower taxes and more liquidity? Greg Abel needs to prove that Berkshire can outperform. But with $381.6 billion in cash earning 500, it's nearly impossible to beat a stock market returning 15–20% annually. The math doesn't work. Even if Abel's operating businesses grow 8% annually and his stock picks return 12%, the massive cash drag pulls down overall returns to maybe 9–10%. That's not enough to justify owning Berkshire instead of an index fund. Unless Abel dramatically deploys cash into high-return investments, which is hard at this scale, or unless the market crashes and cash becomes an advantage, Berkshire is structurally positioned to underperform. That's not Abel's fault. It's the burden of size. But it's his problem now. So given all these challenges, what should you actually do with Berkshire stock? Here's the investment decision every Berkshire shareholder is facing right now, and the answer depends on your time horizon. Should you buy, sell, or hold Berkshire Hathaway stock in the Greg Abel era? Let's break down each option. The case for selling. If you believe the Buffett premium was real and won't transfer to Abel, you should sell. Buffett's retirement removes the primary reason to pay 1.1x book value. The stock could decline to 0.91.0x book value, a 10–20% drop from current levels. If you think Abel will struggle to deploy $381.6 billion effectively and Berkshire will lag the S&P 500, you should sell and buy an index fund instead. If you're worried about the conglomerate discount expanding and activist investors pushing to break up Berkshire, you should sell before that uncertainty creates volatility. Tax consideration. If you've held Berkshire for decades and have huge unrealized gains, selling triggers a tax bill. But if you believe the stock will decline 20–30% over the next few years, paying taxes now and moving to better opportunities might be worth it. The case for holding. If you're a true Buffett disciple who believes in Berkshire's culture, decentralized business model, and fortress balance sheet, you hold through the transition. If you think Abel is competent and will grow into the role over 2 to 3 years, you give him time to prove himself. If you believe Berkshire's intrinsic value, book value plus cash plus operating earnings, is higher than the stock price, you hold because you're buying value. If you think a market crash is coming, like Buffett clearly did when he built that cash pile, Berkshire's $381.6 billion in cash becomes an advantage. When stocks drop 40%, Berkshire can buy bargains while everyone else is selling. The case for buying. If you think Berkshire is undervalued at 1.1x book value and the conglomerate discount is overdone, you buy now while sentiment is negative. If you believe Greg Abel will surprise skeptics and prove to be a capable CEO and capital allocator, you buy before the market reprices the stock higher. If you want exposure to a diversified portfolio of high-quality businesses, insurance, railroads, utilities, consumer brands, plus $381.6 billion in cash for protection, you buy Berkshire as a defensive holding. If you're a long-term investor, 10+ years, and you believe Berkshire's earning power and book value will compound over time regardless of who's CEO, you buy and forget about short-term volatility. My take. Berkshire is a hold for existing shareholders and a wait for new buyers. The transition uncertainty creates risk. I'd wait 6–12 months to see how Abel performs, how he deploys cash, and how the stock trades under his leadership. If Berkshire drops below $700,000 per share, below 1.0x book value, it becomes a buy. Transition. But there's one final issue that determines Berkshire's long-term future. Here's what will ultimately determine whether Berkshire thrives or declines in the post-Buffett era. It's culture. And you can't measure it in financial statements. Warren Buffett built Berkshire on a unique culture: extreme decentralization, trust in managers, long-term thinking, avoiding bureaucracy, and treating shareholders as partners. Berkshire owns 90+ businesses, but has only 26 people working at corporate headquarters. They don't have HR departments, marketing departments, or strategy consultants. They let each business run independently with minimal interference. This culture worked because Buffett was Buffett. Managers respected him. They wanted to work for him. They didn't leave for competitors because being part of Berkshire Hathaway under Warren Buffett meant something. Does being part of Berkshire Hathaway under Abel mean the same thing? That's the culture question. If key managers start leaving, particularly the heads of GECO, BNSF Railroad, or Berkshire Hathaway Energy, that's a sign the culture is fracturing. If Abel has to replace managers, the decentralized model breaks down, and there's succession within succession. Who replaces Abel in 20 years? Buffett built this company to last centuries. But without his vision and leadership, does the culture survive 2 or 3 CEO transitions? Culture is invisible until it's gone. Then it's catastrophic. Berkshire shareholders need to watch for signs: manager turnover, bureaucracy creeping in, short-term thinking replacing long-term focus, acquisitions made for growth rather than value. If those signs appear, the Berkshire magic is gone, and the stock will reflect that reality. So we've covered the 5 critical realities of Warren Buffett's retirement as Berkshire Hathaway CEO, who Abel is, an energy operator, not a stock picker, with no proven public investment track record. The $381.6 billion cash deployment problem that's the biggest capital allocation challenge in corporate history. The conglomerate discount that could expand without Buffett's reputation premium, causing 30% downside. Whether you should buy, sell, or hold, with the answer being wait 6 to 12 months to see Abel's performance before committing. And the culture question that determines if Berkshire's decentralized model survives without Buffett's unique leadership. These are the realities Wall Street analysts are quietly discussing while publicly staying optimistic. But here's something I didn't tell you at the start of this video. Everything I just shared is completely useless if you don't know which companies will benefit from Berkshire potentially breaking up, or which stocks to buy instead if you sell Berkshire. Without knowing the alternatives, you're paralyzed by analysis. Comment under this video, and I will reveal the top 5 Buffett-style value stocks trading at discounts right now that could outperform Berkshire during Abel's transition. I'll see you in the next one.